The title today is One Footprint, Multiple Uses, and this is something which has come a lot more. We had a recent survey at JLL, and mixed-use development was identified as a key area which is going to drive forward hotel development for us. And the panel here today represents a number of the different uses within the schemes. So we've got 4 very experienced people. I will very quickly sort of give them the names, and they'll do their own introductions and tell you a little bit about their organisations and where they fit in within the use classes, and then we'll kick into a discussion. Very much hope that we'll get some questions from the floor, so please keep those coming through. It's quite a small group here, so don't be afraid. Put your hand up, and sort of we'll have some questions as we go. On my immediate left is Anton Bawab, who's Regional President of Viceroy Hotels Group. Next to Sean Worker, CEO of Bridge Street, who I can't see there. Todd,
oh,
yes, Todd Winparry from Trump Hotels, and on the far left, Mark Deliere from Denton's Solicitors. So perhaps I'll pass you on to Anton, and he can kick off.
Good afternoon, everybody. Thank you for the intro, and thank you for taking the time to join us here. My name is Anton Bawab. I run the regional office for the Viceroy Hotel Group. We're a Los Angeles-based hotel operator running 16 hotels around the world, from California, Snowmass, Colorado, Miami, New York, Caribbean. Out of the regional office in Abu Dhabi, we run Europe, Middle East, and Africa. Most of our properties are under development. We have 2 open operating in Abu Dhabi and the Maldives. And we've got a lot of mixed use coming up the pipeline, whether it's Miami, Snowmass, or St. Lucia for the existing properties. Dubai launched late last year, and we've got 2 more in Europe and 2 more in Africa that have mixed use elements. So this is very relevant, and I look forward to sharing the ideas.
Go ahead, Sean.
Thank you. Sean Worker. Have the privilege of heading up Bridge Street Global Hospitality, and we deliver service apartment experiences. We have 6 brands spread across 60 plus countries and about 50,000 units in our distribution. Everything from a 6-star experience to a 2-star experience, and really an integral part of standalone buildings with mixed use, actually with Kimpton in Chicago, where they have half the building, we have half the building, with common entrances. Pretty interesting model. We've done it in New York. It's relatively new for Europe, with buildings all over Europe, and then equally mixed use in India, in Delhi and outside Gurgaon. We have now nearly 1,000 units. Interesting co-branding with Maria Sharapova, Michael Schumacher branded building.
So was that with
like that.
Manosh, who should have been here as well?
That's with Manosh, with Homestead. So interesting co-branding, mixed use, and we're managing the whole facility as well as branding.
Oh, right.
Todd.
Todd Winparry. I'm from Trump Hotel Collection. I'm sure some of you have heard of the brand before. We actually delve into 3 major business areas: real estate, which I'll get back to in a moment, entertainment through ownership of the Miss Universe contest and the Apprentice franchise, and also retail products as well. In the real estate area, our heritage has always been through residential development, primarily in New York City, but we also own and operate 16 golf courses in the U.S. and abroad, and we have a couple of office buildings too in New York City, including the famous Trump Tower and 40 Wall Street. The hotel division, Trump Hotel Collection, started in 2007. We have 9 properties right now, with 3 in the pipeline. As far as mixed use goes, the majority of our projects are actually mixed use with hotel and residential attached. And moving forward in our pipeline, the majority of the projects that we look at, things that we've signed up, are also mixed use, not just hotel and residential, but also adding on office, retail, sometimes service apartment. Those are the types of projects we're working on in primarily China and the Middle East.
And I'm Mark Deliere. I am a hotel lawyer based in London with Denton's. My background in mixed use has been primarily on the brand side. I helped develop the mixed use
policies and procedures for one of the big international brands and have helped another 2 of them evaluate projects, make sure that there's the appropriate legal infrastructure, work with the local council to make sure that the brand's objectives are achievable under whatever infrastructure happens to exist in the country. So I'm pretty familiar with the challenges that mixed use presents.
Okay, let's sort of kick off with something sort of quite general. It's difficult sometimes to get any development scheme off the ground. So sort of the question is, what do you see as the main driver for mixed-use developments? So, you know, is it a design sort of goal? Is it planning? Is it value enhancement? You know, what do you see on that? Perhaps I'll start off with Todd. Throw you straight on there.
Thanks. Well, this is not entirely my particular bailiwick in terms of the development process from ground up, but I can tell you that, of course, having your financing in place is very important, and your planning approvals in place. But you know, like any real estate development, I think timing is quite important as well. If you look across some markets in the world that were more affected by the downturn than others, you see some buildings that are half built. I know Chicago had a handful that missed the timing, and Dubai, we got caught out in one on the Palm that missed it. So I think there's.
But leaving aside the financing, you know, of it, if you're saying there's the opportunity you've got a plot of land, you can develop something. What do you think is really driving us to put the mixed uses together? Because that's what sort of interests me here. Is it just because it's the size and critical mass, you need to mix it up? Can we? I mean, where we might get to on this is looking at the different, whether it's your service, apartments, whether it's a hotel use, and where they're bringing value into the scheme. So
for us, of course, it's the synergy between the two. The hotel enhances the residential value play, and if there's an office next door, that helps the hotel success, and all of that can feed into the retail. So the synergy is important for us. Let somebody else chat.
Probably think about the lens of who owns the land first, okay, and it depends on the jurisdiction. So if we narrow it to central London, well, I think everybody knows about the incredible stories in central London. But if you start to, even in that market, trying to release and optimize the capital, and I think even with advisors helping owners look at their specific space a different way, that can release capital in stages. So it might be that you can stack and you can get air rights and you can go up, not unlike the Shard, but you can't do that across the river. So in that case, it's very easy to stack and have a community that's being built that's dynamic and sustainable. Be it a Four Seasons in it or a Trump, and then service apartments can cohabitate as well as residential in there with retail. So you've got a community, a village in the air. That takes a lot of capital. I think where the rest of us live is in small spaces. You might be converting parking or something like that into a more optimized use. And the question is, from a planning perspective, what are you allowed? Certainly we've seen from planners that they're looking for a more dynamic, community-driven feel to it. And they're dictating some of the conversation about, okay, we like a boutique hotel versus branded. We'd like some residential, we'd like some dynamic traffic that stays a little longer like serviced apartments. And I think the banks are just wedging themselves in there firmly and saying, no, we want something very predictable with low risk at high LTVs, or low LTVs. So this is a very odd time where we're competing with flight of capital that has a very different perspective, that maybe using it for safety, whereas we're looking for an IRR, the bank's looking for a rational IRR. I think it's extraordinarily complex, and everybody here has got different views on it as to how to do that. But office converting to a hotel, office converting to service department or resi, and retail at the bottom is not uncommon in very tight spaces. So I think that's going to be really interesting in Europe, Frankfurt, Munich, other cities like that, rather than the typical Paris and London.
Yeah, I think it's worth making the point. The panel here, I think, got global experience, and what we're trying to do is pick their brains as to what might, the relevance might be for EMEA here, and where the trends we will see. Anton, have you got something to add?
Todd said something very interesting, saying the hotel will give value to the residences. I think I look at it the other way around. The residences will make my hotel possible. It's ultimately when I get involved or when we get called, it's to develop a hotel, and you start looking at how can you spread the risk, and various asset classes have different risk factors, whether it's resi office or office resi retail, office resi hotel, or how do you make maximum use of the allowable built-up area. So you start. Ultimately, it's like a balloon. You've squeezed one side, you have less hotel, you have more resi, or you have more other uses, and you squeeze them.
I'm going to
you get
use
more
that
of a
one.
hotel.
That's a good balloon.
Not always works,
Okay,
but
good.
doesn't translate well to Arabic. There you go. But
Thanks for sharing that.
It's ultimately it's about, for a hotel operator, getting the hotel built and allowing the owner, developer, to hedge that risk or spread the risk over multiple asset classes, removes the stress and allows you to get maximum value from the dear land that you've just paid for, whether that's vertical or spread over.
Okay, and Mark, from a legal perspective, when you start sort of layering these, what are the things that you sort of, the alarm bells go off
I'm going to let him
when
get on with this
someone's
here.
presenting to you a scheme, and you're looking at these different uses, and right at the outset, we will go into some of the more operational issues, I guess, as we talk through. But from a sort of a planning level and those other aspects, do you get involved? Do you see what's driving it from your perspective?
Well, the first thing that I get concerned about, I'm not a planning lawyer, so I'm not in a position to comment on that, but the first thing I look at, because we do work in a lot of different jurisdictions around Europe and in Africa and other places, parts of the Middle East, is what's the legal infrastructure that's going to allow this to be built? Because Viceroy and the other brands are going to have certain legal requirements or certain commercial requirements that they're going to need to be comfortable with before they're going to allow their brand to be attached to some or all of the project. And in many jurisdictions, obviously not Germany, but in many jurisdictions, the legal infrastructure has not caught up with these developments. And so one of the first things I try to do is figure out, am I going to be able to accomplish what the brand is going to need to be able to accomplish in a way that's predictable, sustainable, and likely to be kept in place for a long time. You don't always get that. Part of that's just trying to educate the local folks as to what your requirements are, so that you can get to a place where the brand is willing to say, yep, that works. I feel comfortable that I'm not placing my brand at risk.
Mm-hmm.
Okay, and let's sort of go into some of the different users and how they sort of go together. Then, maybe Sean, just from your perspective, what your customers need from a serviced apartment. How is that consistent with a hotel or the residential?
It's all about the community and the location, and our customer base is Fortune 500 predominantly, and then a high proportion of all of us in the room that want a unique experience on the weekend in a major city, and you want to live like a local. So it's really about finding a piece of an experience. So you want something like we have in King's Wardrobe, for instance, in London, it's across from St. Paul's. There's a health facility around that. There's retail around that. There's the pub experience around that. But you also want to be in an area that is reflective of the price you're paying. So in many respects, our selection process is very similar to a hotel brand, because you're offering a hospitality experience with our 6 brands. We also have a hotel experience, a part hotel, which is this combination of, which is ideal for capital release. So the selection process, actually, if we're doing mixed use, in the case of working with Kimpton, for instance, they've got a unique brand. They have a different experience level. They're boutique with brand standards, and they are quite willing to understand that that guest that is staying with us for anywhere in Europe from 21 nights to 65 nights in the United States is an ideal profile for them to use the hotel as well. So it's complementary.
And use the hotel for
Yes.
F&B?
Yes. So the bar, they have rights in we actually offer room service through the hotel, which we have no desire to offer, so it's complementary. We actually share mixed services, so the pool, mechanical, cam areas or common areas are shared. So it dilutes the cost for the hotel community, but it's seamless for a long-term guest. And this whole debate about should the building be uniformly branded one brand, I think gives some inflection points for a customer to be able to say, well, I have a residence here and I go to the Kimpton or I go to the Four Seasons, because we have also a block in Canary Wharf where we're in the same exact parking area, and our block is right next to the Four Seasons, and we share the private club. So they're getting like-type experiences. So that's driving the experience. So it's actually to our benefit to be associated with a hotel, or a hotel to be associated with us, because we're diluting some of those expensive overheads that are F&B and CAM costs. So it's a dynamic environment.
Do you agree with that, Anton?
I think there's definite synergies, whether it's the hotel expanding its reach to a larger population that ends up being captive in the development, whether it's a building or a resort, reducing the cost, the overheads of that property development, of operating the property. From our perspective, we're very keen that whenever we enter in such a scenario, that we protect our operations going forward. So, to the example we've just mentioned, we would seek protection from an independent owner putting their unit on a website, selling it at a significant discount to what we are selling our rooms at, yet being able to say, come and enjoy the pool deck at the Viceroy, room service from the Viceroy, the spa at the Viceroy, at 20% discount to the Viceroy.
I think it's important to differentiate here. We're talking about we have a single-purpose building with individual owners, possibly, but they're all singly leased. So we take the lease. Okay? So you're dealing with a very, a structured, branded environment, because we also manage the environment where you're putting ring fences around a single owner that can't go on Airbnb. Not that it's a bad thing to go on Airbnb, but it's not actually complementary to your brand.
Allow me to do that.
You want to do that? You want to go on Airbnb?
No, allow me to manage to rent your unit on.
Oh, well,
that's what I'm saying.
okay.
As long as we do that
Fair
logic, then
Listen to Anton here.
and pay me my base fee. And get my
But
incentive.
I mean, it's a good
So-
point. What typical structures, operational sort of ownership structures, are you seeing then within these mixed-use schemes? Are you seeing leases as being predominantly seeing management contracts, franchising? Have you got? And this will be a question for you in a moment, Mark. When you if you've got an ownership with 3 or 4 different structures in there, can that work together?
Well, we're doing that, which I think is pretty interesting. It's also how we've structured the business. The business is a global brand. It behaves like a brand. It has very distinct images. So it's complementary and respectful of other brands, be they retail, which you have to build up that community. So if it's retail and you're putting in a Versace outlet and you have a 3-star select service hotel, that's probably not a good mix. But if you've got a developer with vision, and they want capital release, they've got different fee streams. They might have a long-term, very long-term management agreement with the hotel. They may have a short to medium-term lease with us that has a capital release capability where it might be fixed with the hotel for a 25-year management agreement with no sale provision or something like that. So it's about balancing the cash stream to the owner to debt service on a very mixed-use development. And I think what's that doing for the covenants today is diversifying the risk for a bank. You can sit down and say, well, you're guaranteeing certain fee streams. We run about 90+% occupancy, which is ideal for a bank. They're happy to get the cash every month. Equally for owners, they're getting their yield every month. Whereas if they're in retail, they may get a different form of staged payment with other sorts of covenants in it. But nonetheless, I think it's interesting how capital and yield are now being demanded from sometimes irrational high net worth schemes. That capital is different than coming from a bank, and that's putting a lot of pressure on leases. So,
And are
costs.
are you seeing that the contracts are all woven together? So Mark, you've got a situation where you've got a hotel, maybe some retail, the other aspects. To what degree do they cross-refer to each other so they're not infringing on each other's rights? And is that quite restrictive for a hotel operator or the residence operator?
It can be. I mean, there's a lot of different, part of it's driven by the property. I mean, if you have multiple owners within a property, and I don't mean just multiple hotel unit owners, I mean, you've got, one guy owns the retail piece, one guy owns the office space up top, another person owns the hotel. In that case, getting them all under all three of them under a very long-term agreement is going to be more of a challenge than if you simply have a structure, a legal structure in place where the rights and responsibilities of each of the different component owners is very clearly defined. And so then you bring in an operator to kind of handle the common spaces, and it doesn't need to be quite as long-term an agreement as you would see in a hotel management situation, because you've got the infrastructure there that tells everyone what they're supposed to pay for, what they can and cannot do in their space, and who they have to allow to use their space, or under what terms. So that's one scenario. Another scenario is you were describing, where you control the whole building, and then there's a lot of scenarios where people want the hotel operator to operate the whole space, and the hotel operator says, actually, I don't do retail. That's not something I'm particularly good at. It's not something that really, it's not my core strength. It's not going to contribute to the fee stream that I need. So thank you. I'm not going to do that. I don't know if your experience is different, but
yeah, I was going to say, Todd, what's your preference? You've got a wonderful scheme in front of you, and someone's coming to ask you the questions. I mean, do you have a starting point where you go, actually, what we really want to do is control everything?
World domination, is that what you're saying?
Well, I don't know. You can
No,
watch.
we don't need
Donald.
we don't need to control everything, but we do need to make sure that we've got an ability to control the quality of everything, because we want our brand, our hotel brand sits at the luxury level, so we want all other aspects of the mixed-use project to be at that same level. So we will require a veto right on certain brands coming into a leased area, things like that. But when we do a basic hotel with residential on board, we always offer up that we'll manage the residential. And if we do manage the residential, then we do it very much at a competitive rate. We don't try and, it's not a big profit area for it. It's really much more of making sure that we're controlling the residents and the guest experience. And our residents, we want to be owner occupiers, and we want them to own and live there for a long time, and we want them to get a great premium on their next sale, and that kind of keeps everything going. And our experience with our branded residential in New York is that it's still selling, even if it's 20 years old, 30 years old, it's still selling between a 10 to 25% premium to the same product that doesn't have a brand on it. So that little nugget of information for a branded residential purchaser is just gold. They know that they're going to get that premium.
And we were talking about this earlier, but perhaps, and it's probably worth explaining, branded residences for everyone in the room here today. But to what degree does that premium, is it sort of consistent when you're looking across the areas where you're operating, whether it's in the States or in Asia or elsewhere? And have we seen that within Europe? Can we prove that if you put a Four Seasons or a Hyatt or a Trump on your residence, it's adding that value? Because no doubt it's adding cost for the occupiers of the residences, because there'll be service charge which runs with it.
Well, like I say, the charges should be commensurate with the marketplace for the individual owner. But we have seen variations across the globe. But typically we're selling in Manila right now, and we're at a 22% premium to market. We're selling in Vancouver. It's now a 27% premium to market in Vancouver.
Is that partly because the product is better as well, though?
Well, we try and compare it to like product. Typically, we have to compare it with the highest selling product in the marketplace. So for instance, Vancouver, the highest selling residence is selling there for about $1,000 a square foot, and we're selling for between $1,270 to $1,300 a square foot. And so, I don't know what more can you do than benchmark against the best in the marketplace. But I think, getting back to the branding issue, of course I represent a brand and I'm a believer in the brand, but I think that if you have an excellently located property and you come up with some schmick branding concept or something like that, I think you probably could still get a premium to market as well, but I think it's more of a maybe. Whereas, we've got 20 products across the globe that are all selling at a premium, so that's not much of a maybe anymore.
And what's the cost to the developer of putting your brand on that? I'm sure that's what everyone wants to know.
A handsome branded fee on the transaction, but I mean, going back to your point.
And do you have branded fees on resales as well? Was it one-off?
Interesting one.
For us, it's one-off. We have a structure which Mark might be familiar with, which is a sub-licensing contract, basically. So there's a license that we give to the original developer, and and he owns that until the time that he sells that particular unit. That unit is then transferred or novated to a sub-license agreement that goes with that individual owner, and he's got that. He's bought it. The original developer paid the premium. He paid us a license fee.
But that's not always how it works, because some brands are not willing to give the license to the individual unit owners. So some of the brands will say, the individual who's marketing the unit can use my name, because under kind of a fair use concept of you've got to be able to describe where it is, but they shouldn't be advertising using my logos and my proprietary photography and other intellectual property. Instead, what those brands will do is they'll give the license to the body corporate or the homeowners association, or whatever the equivalent is under that local jurisdiction's laws, usually a royalty-free license, and it allows the association to identify the property with the brand, to put the signage that bears the logos in the common area spaces. But a lot of brands are very, very nervous about allowing just individuals to use their brand.
Ours have covenants that go along with it.
Yeah, okay.
Yeah, it's not just they don't get to just use whatever they want.
Right.
Yeah.
You either brand or you don't. I mean, you can't be half pregnant. It's either you're branding and you allow people to get the economic value of your brand, or you just, if you're not comfortable with people using it, don't. Have the protection in place to identify wrong use of the brand and say, pull it off. I don't approve of that. Have the right to review collateral before it goes out to print. You may not use my name in association with other brands and so on and so forth, but then you're either in or you're out. And if you're charging a branding fee, you're getting paid for something.
Yeah, but that's it's fine when it's the developer, because you're in constant contact with the developer through the sales process. You've probably approved the sales office. You've required a whole series of disclosures and disclaimers on the sales materials. It's another thing when the guy 2 sales down the road is doing what he wants. You have no visibility of it until it's too late, and he's already out in the marketplace, misusing your brand, misassociating it with something. Then it becomes a bigger problem.
Do you have a view on this, Sean?
I always have a view, whether it's right or not is a different matter. Is that, I think where we live is our ecosystem is more defined about recognizing our place. Our place is probably more commercial than the long-term high net worth acquirer of an asset like yours. It's institutional. They more than likely institutional or high net worth. They want to see best use, and they want to see a high capital appreciation with an ability to refinance if it's not in their exit window. And it's very commercial in that sense. It's a combination with, can I sell the hotel asset? Can I sell individual service apartments, which generally we're not in favor of. So how do we get around that? Well, we generally, if you take as a case study, let's say a 150 unit building, we'll probably more than likely put about 90 into serviced apartments exclusively, and about 45 to 50 into residential, generally 4 to 5 star, branded as Bridge Street. And you have this mixed community. So some are very dynamic and exiting in this churn that are separate, and then there is a branded hospitality experience. So it's an interesting release of capital that allows an exit either in its complete form or in partial forms. And I think that's what a lot of people are struggling with today, as opposed to sole exclusive, and plus just getting land to be able to do that is unless you're going into more exotic locations.
But how long will your contracts run? So let's take it, whether it's let's take another brand. Let's say it's a Four Seasons we can talk about, and you buy a Four Seasons residence. how long is that contract typically going to be? And what happens at the end of your, if it's say a 25-year or a 30-year contract and you bought a 4 seasons and then at the end they rebrand, what impact does that potentially have on the residents? I don't guess any of us are doing it long enough to have got to the end of the 30-year contract. But yeah, the theory applies.
So you're saying if it debrands at the end of 30 years,
yeah. So you've had
what's the value of your asset?
Yeah, well, does it affect the resident and what controls for the people who bought it? Yeah.
We typically put in a cross termination right. So if the brand comes off one aspect, it's coming off all of it.
Come off the other, yeah.
If we want.
It's really common. Yeah.
If we want.
But that's from your perspective. But if you bought the residences,
Get out in year 20.
Well, no. If you bought the residences, you obviously you want to have that full disclosure about that possibility, because it may impact your value. And then I'm guessing that what will happen is if this situation were to arise, the body corporate or the owners association or whatever would have to get together and have a bit of a chat about whether they want this brand to pull off. And I'm going to guess that there'd be a lot of resistance to it because they paid that premium up front for it.
That's typically covered in the bylaws. If
That they got to get together.
right, and the CAM and the common area community and all of the formation documents would contemplate that if that was at that stage, and they'd know it at 25 years and deal with it.
Well, the
and
bigger
particularly
risk-
if your firm wrote it. Right?
Good point.
Yeah.
The real risk, though, is that it doesn't happen at the end of 20 years. It happens at the end of year 5,
Right.
when the operator and the hotel owner are
Separate.
at loggerheads, and either the operator chooses to move on or the owner, through some mechanism, gets them out. Then you have a real problem, because as an owner, you're worried about liability being sued by the people who purchased your units. So you better make sure you've disclosed that if the operator goes away, the brand goes away, even though you as a buyer have no control over that. You're just along for that ride. And as an operator, you want to make sure you don't get dragged into that fight, which you invariably will.
But I think there's certainly a trend, and I know we keep speaking about the upper upscale and luxury, upper luxury, is that even if you look at the Candy Building in Knightsbridge, it's known as the Candy Building, yet it has a little plaque about that size that says managed by Mandarin. So there's all these, essentially layered level of services and branding that I think is becoming more interesting and more pronounced in real estate. And again, I think the conversation should be, clarified for the audience as to whether we're talking about high-density urban, primary, or resort, because the resort has a completely different mixed use with a lot of services and experiences that, it's a second home as opposed to, in some cases, a primary home with a second home at the resort. So it's an interesting legal dynamic, but equally I know we're centered on resi here, but I think the experience with commercial and that commercial floor that is becoming far and more prevalent, to use storefront, because you don't want your $5 million, euro, dollar apartment on the first floor. So that all that concern, I think, from a legal perspective is, the survivability of retail. And that's had a lot of impact, and particularly even in places like Knightsbridge, where people are equally handing back leases when it gets too much. So, that's the extreme. But I think where everybody else lives, people are still concerned about that same mix.
I would add that whether it's hotel owner, individual apartment owner, or body corporate or owners association, they actually do have a bit of leverage, because I know for our brand, I'm sure our other competing brands, we don't want the name coming down. Ever, pretty much. But we certainly don't want it down in the short term. Not necessarily because of the cash flow that goes along with having the management contract or whatever, but really, if the name comes down off the building, it will be our fault. Completely convicted fully guilty in the court of public opinion because there was the name there and now the name is gone. So obviously they must have screwed up. So you know, there's leverage there. We don't want that issue either. And part of the reason why we fight hard on performance termination to make sure they're completely fair, because if we are performing but the market's taking a dive or whatever, you know, we don't want, again, the market to think that we screwed up when we actually didn't.
Okay, I think we'll come and talk a bit about the financing of these schemes because we touched on it right at the outset. But before I do that, are there any questions from the floor you want to sort of get into the discussion at this stage? No, we're happy. Okay, let's go.
There's a question
Oh,
right there.
sorry. Yep.
Yeah, I actually have a question. You know, you talked about how you try to align the interests of the different revenue streams, but in your case, you mentioned about retail. So if you have like a property that's luxury, you know, put a Versace in there, it would make sense. What about for F&B outlets or the spa? How do you sort of coordinate the different outlets? So, you know, it boosts and enhances the whole property. Do you structure the leases so they have percentage rent clauses? So, you know, there is some sort of promote structure that helps the hotel as well, or the developer, the owner? Or is it really just like a triple net type thing where they pay for the build out, which helps ultimately, you know, smooth out the operating profile?
I think we'll all have different answers to that one. So
I don't think there's a one-size-fits-all logic. It depends where and who and at what point the operator is coming on board and what's been leased, what's been promised to who, and what's been sold. But it's always a combination of all of the above in some shape or form. Ultimately, as a hotel operator, if we come in from the onset, we'd love to have as much control and an opinion on who's operating the F&B in our hotel, and does it complement what we bring on board, or do we do away with our own F&B operation? Can we integrate them with our back of house? Can they service our room? Can they provide room service and so on? So it all depends on the chronology of who came on board first, and if the hotel operator comes in last, you can inherit a lot of stuff that's hopefully bright lawyers drafted before you. But otherwise,
Typically, if we're operator, you bring up a really good point, which is in the case of Versace, you know, it's fine. I don't care what the lease terms are. I could care less. It's going to be Versace. Well, maybe a different brand, maybe Armani.
It's not what
Anyway,
you tell your broker.
but in the case of the food and beverage and the spa, then you have direct guest experiences. So now I am concerned that this guy's actually going to make money, that he's not going to be scrimping all the time, that he's actually going to provide a great service. I mean, that goes straight to our brand. So we do try and build in covenants in the lease that give us an opportunity to either step in if quality's diving, or at least have some sort of a review mechanism in the beginning, so we're not getting a mismatch of quality.
Mm-hmm.
do you also look at the guest journey? Whereas one of our big concerns is the guest should not know. If they're in that resort or that building, the guest should not know that this is run by a different entity. The guest journey should be the same. You should always walk in there. In a few cases, we make sure that operators get the same viceroy induction. They get to understand what the viceroy values are, greeting the guests, and same ethos. So the guests should not know that this is a lease that's not run by the hotel. They can still charge for the room, and so on and so forth. Do you have any of those comments there? Or
we lease out so much space in our own buildings, and you know, sometimes we get it amazingly right with Jean-Georges in New York. You know, he kills it. He's there all the time, and everybody loves it, and everybody knows it's Jean-Georges, not us. In the case of others, which I won't mention, we think we got it right. They're branded operator, that's a branded lessee that's done great food and beverage or spa work in other places, and in our particular property, it just doesn't work, and then we're kind of stuck with the lease, and so we've done it to ourselves. But we do try and...
I'll take a bit of that from our perspective. I mean, you bring up an interesting concept, and we're more concerned about the experience, that it's authentic. So in the case of an apart hotel, so I'll move away from London and New York and all things exotic to Birmingham now. Anybody know where Birmingham is?
Alabama or
Right.
Midlands?
Yeah. It could be all of the above. Yeah. So Birmingham, we have a building there that we're the anchor, and part of that reality of a very strong presence brand, that we're with an apart hotel experience. We've got people staying there now 3 days, 3 weeks, 3 years. Some of it's residential. We built into our lease that the guest experience had certain mandates with the other tenants, and one of had to be a branded fitness experience, and the other was a original, authentic wine bar coffee concept that wasn't Starbucks. Sorry to say that. I love Starbucks, just we wanted something different.
Just not the coffee.
Exactly. So, but nonetheless, it was about bringing this authenticity to a corner, a very high-profile corner, that you're getting a 4-star plus experience, but it's something you're going to get that's different. Now, we have step-in rights in the event that the food and beverage operator or the fitness operator isn't actually adhering to our service scores, and equally to social media. So we've built in our service scores and what TripAdvisor is saying about their experiences and ours. So we're indexing to the mobility of and bringing social media and a real life experience into our buildings. And you know, it's complex to negotiate that with the banks and the landlord to say that this is a twist. But you know, when you're occupying it for 15 years, you want to be secure that regardless of whether you're in Manhattan or Birmingham, that it's consistent with what you're offering, and the step-in rights in that. So that's more complex.
Yeah, I think I'd add my experiences in terms of some of those other uses and what's driving them. It's where's the value?
That's it.
Is the tail wagging the dog, or is the dog in control? And when you look at some schemes, and we've talked about the residential elements, in the majority of cases, the residential is often driving a lot of the value. So it doesn't mean that you compromise on what you do, but it perhaps impacts on the commerciality of how some of those agreements
It's an excellent
are drawn.
point. You know, you've got somebody who is buying off on, I'm going to live there, but I want a complimentary or better because I go down and work out 4 days a week, or I want to grab my coffee on the way out to the train, and it has to be complimentary regardless of what level you're at, and building that in. And I'm sure that's complex in your world, Mark, where you're trying to build that in and keep everybody happy and put it in a legal term.
Well, keeping everybody happy is
I was teeing that up for you. Happy lawyer.
Everyone not too unhappy, is that the...
Well, but
That's a great
exactly
point.
that's the exact point, because people who are generally happy, what are some of the lessons we've learned from the mistakes of the last 10 years is people who are generally happy. They don't have to be ecstatic, but they can't be profoundly unhappy, or otherwise they sue.
Right.
I mean, back from where I'm from, the first thing you do is you have your lawyer fire off a letter saying, I'm really unhappy about this. So when you're putting these schemes together, try to do something that makes sense for everybody in the room, as opposed to just grabbing all you can, which I know can be a little counterintuitive, but in the long term, it tends to serve the project better, because if it works for everybody, it works for everybody. If it only works for 2 people and everyone else is unhappy, you're going to have the churn that's going to be destabilizing to the project, it's going to be destabilizing to the brand, and will ultimately, it just won't work.
Okay, just before we come into the financing, I was going to ask you about relative values, because we sort of touched upon that, and whether you see any consistency on the pecking order of where it comes out. I mean, if I look at central London, for instance, and you take a sort of prime, not super prime, but just the prime on the residential, you might get £4,000 a square foot on your capital value. Your offices in your West End prime, maybe 2,500. Say a hotel. I mean, if you had a 5-star hotel at £1 million a key, that may equate to £1,000 a square foot. So it's a lot lower, and the construction cost will be everything as much, if not more than the offices, and maybe aligned with some of that residential. And the retail will drive more value. So, are you seeing a similar sort of pattern wherever you're developing?
I'll just share this, and I'll keep the group anonymous. We did a Dragon's Den, apparently, or at least that's what I thought I was heading into. And it was the debate between residential hotels and service apartments. And it was absolutely about yield. I mean, at the end of the day, what's the best use, regardless of what we think our brands offer or contribution. And, depending on the market, you might see some extravagant asks at 3% yields that they want to sell at, and want a 8 to 10% on the other side, for the return. So I think there's somewhere in between that, but certainly from a residential perspective, it's perceived as being more liquid, and the upfront is substantial, as you're noting. So it's hard to argue with, but we've also seen, you said that hotels have been financed for the last 50 years. I think Antonio said so. They're still being financed, and there's a place for it. I think it's going to be a very interesting couple of years ahead of us, as generally most of our markets are undersupplied, as the financing piece has shrunk, and people are looking for liquid investments, and you're getting your best yield right out now, candidly, out of residential, because it's relatively liquid. And you can sell it off in chunks as opposed to selling off a lovely suite at the Trump, which is difficult to do.
Let's go and talk a bit about debt. At the senior level, what are the questions that lending community are asking? What are the fundamentals which either make it fundable or unfundable? And there's probably some bankers in the room who may want to sort of comment on that as well.
I guess it depends what the value driver is. If you're talking about a predominantly residential scheme with a small hotel attached to it, bringing a value, adding the brand, providing all the niceties, giving the assurance of a certain consistency and quality of service to the residences, but the value is coming from the residences, then the pro forma and the potential of the operator become insignificant compared to what the market tolerance or ability to pay per square foot is, because that's the 90% of the value, or if not a bit more. So I guess it's a weight, and it's a fine balance between what the market is, what's the mix of the development you're looking at is.
Todd, are you seeing is there good availability now?
No, not really. Where we're working, like for instance in China and Brazil, we're not dealing with much debt at all, if any. In the more developed world, we're seeing, you can get 50 to 60% loan to value in different structures about when the drawdown comes through the residential sales. But it's still not a great environment from a debt perspective. I think the bankers still prefer to lend on an existing asset than a project right now.
Plus the uncertainty that sometimes comes with these bigger, more ambitious projects, the phased projects, the banks get very nervous that they're going to be left with a half-finished project. You were describing the concept, the buildings in Chicago, particularly in some of the resort areas where you have multiple phased residential, you have big amenity areas, and the concern is that the owner developer runs out of money, having built one residence building, sort of the spa. The marina's not really going to get there anytime soon. The pools are 2 of the 4 have been built, and the banks recognize that that's the worst scenario, because they're either going to have to scrape it and start over, or they're going to have to come out of pocket a lot of money to.
So how are they safeguarding? Or can't they?
Well, you can. They safeguard it in a number of different ways. They require the project, each phase of the project, to be sustainable in and of itself if the rest of it doesn't happen. What you're not going to do is just build out a certain portion of the residences that can't operate independently with the adjacent hotel. You're going to make sure that if you have to stop at the end of a phase, you still got a good product. That's the best way to do it. I mean,
And it doesn't look incomplete.
It doesn't look incomplete, and it doesn't deliver less than the brand is going to be comfortable with in terms of the quality of the service that the guests are expecting. It looks like a finished project, and the great news is if the market comes back, there's
A smaller one.
more opportunity.
A smaller one, but
Yeah.
complete, and
Yeah,
then you can.
We should have plenty of experience of this kind of project from the last few years,
Yeah.
the ones that have stopped. And are they difficult to start again, though? I mean, when if you stop a project, does it then bring on a whole range of new challenges?
Well, part of the problem is you now have guests sitting adjacent to a construction site, so the hoteliers get very, very nervous about that. People are not interested in being on the beach with big sand loaders running behind them, or the golf course being torn up or whatever. So the challenge is it always is for a hotelier, is just providing that guest service, even though there's change going on around them.
Okay.
I think just like to again divide the horizon of financing and what their objectives are. If you're looking at an institutional type investor, they're looking for length and yield. For let's say it's a pension fund or some type of annuity-based investment. So they're really looking at, okay, well, they've strong capital, they have probably fairly reasonably cheap capital to deploy. So So they're looking at the covenant of who's going to take that on, and can they sustain it over that time, and is there enough breaks in that term that most brands wouldn't be willing to do. We do, and we look at it over a 20-year horizon and try and find compromises and incentives to break, because that's the type of one sliver of financing groups that we work with. Equally, we work with Grosvenor and British Land and have very different demands. Whereas I think what we've also seen come into the market is high net worth families that are going as a direct lender, which is pretty interesting and a pretty interesting dynamic to either fill in the cap stack between 55% and above, or take a primary senior debt position at premium rates for maybe some edgy projects that they then take possibly an equity position in. So it's getting very creative as high net worth families that are incredibly globally mobile with their capital are taking very creative ways to fill in where the banks are. I mean, I'm sure you've seen that with some of the clients you're dealing with. And so it's getting very interesting where the banks are retreating in their LTVs, and there's a flow of capital from just very creative spots. So I think it's horses for courses as you kind of look at it, but I'm sure you see it all the time because you're out there trying to find financing for building.
Yeah, we're trying. I want to see some answers.
Yeah.
Going back to Mark's point, though, there's a silver lining when a project is half finished or 2 phases of 4 are done, and then we come back 4 or 5 years later to build the other 2 phases. We do away with the whole speculation of what is your brand bringing. Because we've got performance, we've got history, you've got precedent, you've got, I sold it 2 years ago, or you sold it 2 years ago for X, now you're going to command X plus 1 or X plus Y, and therefore my brand is worth. And if my brand was not worth that much, you wouldn't be continuing it, you would do something else. So it takes out the whole argument of what's your brand worth. Silver lining in there. You can put up with a couple of years of construction, but...
Okay, any questions from the floor? We've got about just under 10 minutes left. Any burning issues?
Yeah, now from the owner's perspective, as the owner of land, obviously you're seeking to optimize value. Now, I'm just looking at a scenario where you have a hotel development and then retail, as opposed to service departments. And you're probably likely to have 2 different sets of operators. How do you sort of juggle that? Just want some insight on that.
Who wants to?
You're very unlikely to have the same operator for the hotel and the retail. So if you have 2 separate operators and you still want to retain the value, how are you going to sort of juggle that?
Do you want to pick
Well,
that
we
up?
actually dealt with this situation for a project in Africa where there were 2 hotels at opposite ends of a retail mall, and they were 2 different brands. And obviously, one of the brands was of much higher quality than, it was just a higher segment, not a higher quality. It was an upscale, and the other one was more of an economy. And obviously, you're not going to maintain the hotel to a hotel standard, or the mall to a hotel standard. What you did was you just made a couple things. One, you made it absolutely crystal clear that the areas that were within the control of the hotel, and that the brand could then make sure that the entrances were exclusive to the hotel. It had complete control rights over who got to enter, who didn't. You made sure that whoever was managing the retail space itself was somebody of a sufficient quality and caliber. There was an owners association, because you had different pieces owned by different people, that had approval rights over who was going to be managing the hotel. And then one of the brands actually insisted on self-help rights, which I don't know how you'd actually enforce that. It'd be very difficult to do, but they felt that having those contractual rights to be able to go in and actually clean up or paint or do whatever is something that, at least in the area that was directly impacting their hotel. Now, the bigger problem is when you have a big mall, you're going to have all sorts of different kind of product in there, from the high-end retail to the dollar or the pound penny stores. And that becomes much more difficult to control because the owner is going to say, I got to lease the space.
In one of the instances, we made it clear that we expected a certain criteria, a certain level of retailers in the areas adjacent to our...
Right.
It was one structure and the hotel was on top of it, so at least the entrances to the hotel, you were not walking from the dollar store into a lobby of a 5-star hotel.
Right.
And that was the high-end element, high-end part of the mall, and then that transition, which works well if master planned properly and spaces are allocated, finishes are allocated, and before you start leasing out the retail.
But that's the big piece, the master planning piece, because when you and this is why it's troublesome in some of the more developing countries, they don't have this concept yet built into their laws. But if you can get a good, solid master plan that protects the interests of all the constituencies and says, you know, the hotels have to be at a certain level, but the mall has to be at least at this level, you know, good enough as opposed to falling into disrepair. If that's built into the governing documents, and the law provides for a good enforcement mechanism, that gets you.
So
It gets you about as far as you can get, I guess.
It's a good idea to have a development advisor, for example, start with the project.
Absolutely. I mean, it needs to be designed as at a single time, because if you try to piecemeal it, if it's connected, I mean, obviously if it's different buildings and, you know, you've got out parcels, then it's different. But if you're going to design, you have a plan that you know you're going to have a hotel over here and you're going to have a major luxury tenant over here or whatever it is, you need to think about that all up front, because it won't work if you try to cobble it together and bolt on things later.
But I think also to add, your question was a bit about how you extract the value and cope with it. You know, it depends at what point you want to extract the value. So you can have a strategy. If you're doing it early on and you're trying to do a land sale, then you'll have to look at that ownership and how you're leasing or management contracts and who are the investors are going to be to exit. You may have a different story if you're taking in and delivering the development and then seeing it through and seeking an exit further down the line.
It's actually a very good question, and it's something we deal with all the time. In fact, we're dealing with a project in Central America right now that they want to build a residential, and they want to do a hotel on the lower level, and I think there's an office as well. For this tower, I think it's too many different uses. For the one, the core is going to be too huge. But they haven't done that. They haven't thought about how all the different users of the different space, what their needs are, and what they're going to, and how the design will affect that. Because I think your issue is not necessarily your operators. That's not going to affect your brand. I think your issue is more what control you have over the quality that they must maintain, and that the design is, from the beginning, the design is built to deal with that. Because you do have different constituents. A hotel guest wants one thing, a retail person wants another. In terms of, particularly, the hotel guest is going to want security. So how the hotel interacts with the retail space, you need to, I mean, that's a simple one. But you need to build that in the beginning. And I think that will hold your value more than the fact of having two different operators. That shouldn't be a problem.
I'd echo that. We're doing similar type projects in India, and it's all about convincing the owner early on to spend the money on having a proficient and high-grade master plan, and then discussing the intricacies of how it's used and how it's experienced, and talking about the retail in advance, and talking about when they actually don't survive the same length as a hotel, and what are you going to do then? And are you just going to fill the space or wait till it fits? And what are your rights as a brand to say, remember that conversation we had 3 years ago? It's not the right brand.
Particularly in the case of shared services, you got parking, and you got
Exactly.
how your services come in and out of the
That's
building.
right.
And are they sharing the loading dock? Are they not? Are they the same employee entries or not? A whole slew of issues that need to be thought of beforehand, and that again goes into the design and the legals.
Yep.
I think we need to wrap up very quickly now. I was going to ask about sort of what you see as the next new innovations on the mixed use, or the alternative is where you see the opportunities, where the new exciting place is going to be to develop. So maybe, if you want to pick it up in a sort of quick 30 seconds here each, just to finish off here, that'd be great. I don't know who wants to kick off. Anton, do you want to? Or
I think we're still, in the Middle East at least, parts of Europe, we're still discovering the condo model. We're still discovering the value that can be unleashed from co-branded or mixed-use products. So I think we have a few years ahead of us before these schemes mature and before we start uncovering the caveats and learn, or at least go through the learnings that the North American market has gone through. So the value for us is continue to finesse it, make sure we learn our lessons, and be a bit more courageous with a few of them.
For the sliver of the community that can afford luxury, I think it's luxury multiplied times 10 as to what they're going to look for and demand for, and have multiple locations where they live. So I think it's going to be very interesting. I think the center portion of the population is going to look for, I think we're going to look for smaller spaces, more urban, social spaces to be in, and that's going to be a conflict with the developer because they don't want to give social spaces. So it's going to be very interesting in that. And I'm excited about non-London markets, you know, where you're looking at Munich, Frankfurt, Oxford, Cambridge, where, you know, there's going to be a migration, I think, because of barriers to entry for living. So there's going to be all new communities developing, which I think is going to be fun.
I tend to look at the absolutes in a market. One absolute is, we touched on earlier, the issue of the highest and best use. And if you go in any market, you know, it's probably residential makes the most sense, then maybe office, then maybe retail. And like way down is the, you know, bastard stepchild of hotels that just is too high risk, and your return doesn't come back until 30 years.
You make us feel so special.
So they just don't get built as much, and you know, there's markets all over the world right now that are or could become very severely undersupplied. So how do you deal with that? I like the markets where the municipality has identified that. Right now, Tokyo is a classic. They won the Olympics 2020, and they're like, crap, we need more hotels. How are we going to do this? Now, they have a scheme whereby you get a expended FSR if you add a hotel to your building. That's why you find so many hotels in Tokyo that are at the top of office buildings, because they could build bigger if they added the hotel to the top. I think moving forward, municipalities will start to realize this, that hotels are really important, but developers can't build them, they don't make sense. So they have to then make it so they're put into a mixed-use component, because then all of a sudden the hotel actually can start to make sense. So I think those cities that are realizing that, and Rio did, although not
Probably
quite as
too
effectively
late.
as other places. But I think that's where I see the future, is those municipalities where you have difficulty in getting hotels built. I think there's going to be opportunity there, and it will probably manifest itself in mixed use.
So just to take a slightly contrarian view, one of the things I would suggest is mixed use, and particularly mixed use residential, isn't always the right answer. I mean, there were a lot of projects that were built with mixed use where they branded the residences. Part of it was the economy tanked, but they're not always the right solution. Maybe it's an unbranded residence, or maybe it's you know, strictly a retail component, or maybe it's just an office component somewhere in the building. But it's not a one-size-fits-all model. So, you know, look at the opportunity, but be very frank about whether you're trying to make something that doesn't really fit in that environment.
Okay, thank you. I'll wrap it up here. I think the message is pretty clear. There are so many stakeholders within the mixed-use schemes that the important thing is to understand what people want now, what can be delivered now, what works in 5 years' time, 10 years' time, 20 years' time. And if we can get that right, God, it's amazing. Can you please thank the panel? It's great